Hello, everyone, and welcome to TradeFinder Live. It's great to be back with you all during this trading day and during trading hours. My name is Zack. Most of you are likely familiar with me by now, but if you're new or joining us for the first time, welcome. It's great to have you with us. We first and foremost have to cover our disclosure disclaimer agreement. If you've attended any of our live sessions, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. Please feel free to take a screenshot of that now if you like, but that's the main point to take away. Other than that, with today's lighter inflation data, it makes things in the market in a state of flux. So where does that mean we go from here? I'll let the expert answer that. So Rob, you out there?
I am, Zach. How are you on this Tuesday afternoon? Howdy, everyone. Welcome to TradeFinder Live. And yeah, so we get a little bit weaker PPI. What does that mean for the CPI tomorrow? We just kind of got used over Friday and Monday to seeing economic data that was more inflationary. And then we get a little bit of a tamer number today, but the market doesn't put as much weight into this one as they do the CPI. So tomorrow could change everything. But let's look at the S&P and see where that does bring us at this point in time. And one of the things we talked about yesterday with Evo Trader Live for our alert subscribers at evotrader.com, as well as the HUBB trading room for those that have the AI signals with the HUBB platform. If you're not familiar with it, go to HUBB.com. You get live Elliot Wave, free Elliot Wave, and then you have the opportunity to get those AI signals if you're interested. But in both of those webinars yesterday, we talked about how we had this close here on Friday below pretty significant support level on the S&P, and we wanted to see if Monday was going to yield a follow-through day. It did not. We closed above the closing price on Friday. To get a true follow-through day, you have to have a lower close. And that brings kind of an interesting topic into play, because when you start talking about follow-through and confirmation days, you get out on the internet, you look around, everybody does that, and there's so much misinformation on the internet, as we know. But this is not necessarily misinformation. This is just a differing of opinion. For me, a follow-through or confirmation day needs to be the next day. But if you read information that's on the internet, a follow-through or confirmation day can skip a day. And then, in other words, if we close lower today than we did on Friday, that would still count. For me, it doesn't, but for other people, it does. So again, it's a personal preference type thing when we get there. So you can see that right now the markets are lower than where they closed yesterday. Remains to be seen where we close today, obviously, but if we close today below Friday's close, some would take that as to, okay, well, that's a confirmation day. Maybe. We'll see. But the bottom line is that we have not made it back above the 10-day moving average. So regardless of what method of a confirmation or follow-through day you look for, whether you're like me and you prefer it to be consecutive days, or you're okay with a day in between or so, the difference is negligible. But the 10-day moving average is that's not negotiable. That's the short-term moving average, pretty widely viewed. We've had this bearish 1030 cross that occurred back here at the end of December. And until we can recover that, step one, get back above the 10-day moving average, and then have the 10-day moving average cross back above the 30, we still have to lean in the bearish camp. Now, there is no question, I don't think, that there's a support line right here at 580. And if we can hold above this line, that would be perhaps step one if we closed above there and even didn't get above the 10-day moving average. But none of those are occurring at this point in time. We are still below that support resistance line. So as I go and condense the chart a little bit more, you can see that we broke below it. And I would consider this a test of the break of that support line. So that's what I think is going on. And perhaps we just wait and see what the CPI report says tomorrow, and then that gives us more information on where we're going from concerns over an inflation standpoint. We'll take a look at the bond market in a second, which is not really given any sort of relief. You know, the bond market has been raising yellow, red flags. You listen to the financial networks, and they just dismiss it. And maybe they're right, but my experience, and I've been around a long time, is you never ignore the bond market. You've heard me say that numerous times, and I still stand by that. And even if it's wrong this time, and it would be the first time that we had this inversion and no recessionary standpoint. Well, if you look at it the other way around, every recession has been preceded by a inverted yield curve. I still think that there's concerns out there, and they're to be heeded. But on the bullish side of things, if you are looking for things to go along the market, we do have this wave 4 that's right around a 50% corrective level, and we could turn and move back to the upside. I just think that to go bullish again, we need to get back above this support line, back above the 10-day moving average, and then the ultimate would be getting a positive 1030 cross. Then you can say that whatever's going on in the economy, we're okay with. So as I was mentioning the bond market, let's take a look at TLT. Remember, this is prices on the 20-year bond, not yields. The TNX shows yields and rates. I'll show you that in a minute because some of you like that. You mentioned it in the U.S. market update on YouTube. But notice how prices are continuing to go lower. We're exactly at 100% extension on this wave 5 on the TLT. And as prices go down, yields and rates go up. That's just not good for equities. As the yield curve continues to widen, on one side of things, it's like, maybe that's not so good for the economy, but it's good for financials that they lend and borrow on different ends of the yield curve. And so as the yield curve widens, that gives them a bigger spread to make money on. We're going to start seeing earnings come out from JP Morgan, I think leads it. And then we'll see all the financials follow right after that. But is that early enough to help with last quarter? Or is that going to be a next quarter thing? But it will be interesting to see how the financials fare with these increased rates. Remember, they work on the yield curve, the spread. The yield spread is what really determines profits on the financials. We are a little bit below that 10-day moving average, but I said that yesterday as well, and we're still moving a little bit lower today. We're not significantly below the 10-day moving average, so we could continue to creep lower. This movement that we've had kind of since mid-December would be a little bit more in line with how the bond market works, but this kind of stuff is not where we had this fairly steep move from early October through mid-November. Then we had a little bit of a bounce, and then the move again from early to mid-December down to where we are now. This is pretty volatile action for the bond market. It usually doesn't move quite this directionally. This is unusual, and you've heard me say that over the last week or two. But now we're in the middle of this tap box, the time and price projection box, the wave 5 on the Elliot wave pattern on TLT. And now we just have to wait and see what happens from here. If we can get some sort of relief. Just listening on the financial networks before we came on live here, Josh Brown on CNBC saying that this year you want to be in small caps and mid caps. Okay. If we're going to see some sort of I think maybe he's saying that where he feels like the selling is overdone here in the bond market, because most people, myself included, feel that the small caps are rate sensitive and they perform better when you have lower rates, not higher rates. And the reason for that is because smaller companies normally need to borrow capital. And as rates are higher, it costs them more. Usually when you're starting a business and you're growing, you need capital to create those expenditures to grow your business. And the more it costs you, the harder it is to generate gains, obviously. So that's why small caps are typically viewed as being more sensitive to rates, among a few other things, but that's the primary one. So when we have prices moving down and rates moving up, to say that small caps are the place to be, it's a contrarian call, and viewing that perhaps this is it. And maybe it is. It is a really well-formed wave 5 pattern to the downside. I mean, look at this. The wave 4 at 54%, so right in between a 50% and a 61.8% correction on the wave 4 yields 100% extension, which is exactly where we are. If we do get a break in interest rates, if we do start to get prices to come up and yields and rates go down, I would agree that small caps will probably outperform because they've been underperforming. So kind of switching the order around from the way we usually do things, let's just go ahead and look at the IWM. And you can see that we have a wave 4 at 75%. Technically has not disqualified this 5-wave pattern because we have that 78.6% fib level that keeps it in play. That's why it's still labeled. But if Mr. Elliot himself was here, he would say, I think there's a good chance that this 5-wave pattern becomes disqualified. His viewpoint, and this goes beyond just the primary published materials that he has. If you start reading his thoughts and comments, there's a lot of chatter and rhetoric about Elliott wave, where there's a difference between rules and guidelines. You could call this one of his guidelines, was that once you had a wave 4 past 70%, there's a high likelihood it's going to reach a point where it becomes disqualified. But there is a chance. Are you saying there's a chance? Put in the chat if you know what movie that's from. That we could still hold here at 78.6 and then move back to the upside here. I know Zach knows what movie that's from. But 78.6 is the final fib level before it becomes officially disqualified, even though Elliot's view was once you pass 70%, it was a greater percentage likelihood that that's where we were going to go. But we've seen 5-wave patterns that have held at 78.6% and above, up to 70%. And still turned and moved to the upside. That's why it's still technically a pattern. But the one thing that you could take away that maybe is showing that the market is just tired of rates ticking up is the fact that I showed you the TLT was actually down, rates were slightly up, and yet the IWM is a little bit higher today. Not much, but a little bit. So at least it's not going lower, which is the main thing to take away. If we take a look at the VIX, we're staying elevated here on the VIX above 15 and above. Maybe we need to raise that floor from 15 up to 17 and a half. Maybe that's going to be the new floor, but for 15. But notice this is a concerning trend where we have this trend line here on the VIX of higher lows as we continue to move up. And that could create, you could argue that with Monday's selling that maybe we should have had a higher VIX, but it really wasn't that significant. And then today, basically not really much going on. So Friday and Monday could have been higher VIXs. They weren't. But since we're making higher lows, we could have another one of these big spikes is what I'm trying to get at, as we saw right over here in the middle of December. These big spikes, they're short-lived. When it spikes like that, works just like any other security on getting too far away from the 10-day moving average. But it's just the market feels weaker than the VIX is showing, I think is what I'm trying to say. And when the CPI report comes out tomorrow, if that's a bit hotter, along with that jobs report that came out on Friday, we could see some renewed selling moving on. Let's look at the Dow. All the big indices broke support levels as we moved into the end of last week. And note that the Dow, or the DIA, is back above 420, which is its level. Its wave 4 is only down around 44, 45%, so not even quite to 50%. Hasn't made it back above the 10-day moving average yet, but getting back above its support line that was broken. And so not looking too bad there. The Dow performing pretty decently in today's market. And then if we take a look at the Qs, which have ticked back down, which you would expect with the bond market acting the way it is. We have a little bit of a descending triangle pattern here. We've broken below the 50-day moving average. It was the last market to give us a 1030 bearish cross where that 10-30 moving average moved below the 30-day. And so maybe we're starting to get to the point where the Mag 7 stocks, tech stocks, just can't handle the weight of the rates moving higher. We got that big post-election bump, renewed interest in the Mag 7, the big tech stocks, but now they're starting to succumb a little bit, breaking below that 50-day moving average and below the support line right around 510 on the Qs. If we take a look at the metals, gold, we talked about this yesterday in our meetings as well, had come back down, and the question was this a breakout of this really nicely formed symmetrical triangle and just filling the gap, or was it a false breakout? Because you could make an argument that it's just a larger triangle being formed here. That wasn't a breakout attempt. It was just another series of lower highs on the upper trend line. Man, it would be hard to argue with that. For now, though, I still am going to keep the pattern here with the fact that that was a breakout, and then we filled the gap on the breakout, because that's one of the things that occurs when we break out of triangles. Sometimes you just take off and run. Sometimes you have a gap up, you come back and fill the gap, and then you run. And then other times it's a false breakout. Not in anywhere near a false breakout camp yet, but you could make an argument that, nope, there was no breakout. That was just simply forming a larger triangle. And then looking at SLV, which is in a descending triangle, not the same symmetrical triangle that GLD is, but yet a consolidation pattern nonetheless. And you can see we're moving in towards the point of this descending triangle pattern. The metals are going to break out. And I've been spouting towards the end of the year that I think the metals would be on pause until we find out if President-elect Trump is going to enact all the tariffs that he talked about, or whether or not that was just posturing and jawboning to try to get what he wants without actually having to enact these significant tariffs. He doesn't seem afraid to do it, but he actually has to do it for it to be a direct effect, other than just listening to the rhetoric in the comments. And SLV seems to be content on that. Let's just wait another couple of weeks and see what he does right after the inauguration, where GLD perhaps is still in a larger triangle, but for now, it looks like maybe it wants to try to move out of it, and it's just filling the gap. Looking at oil, a little bit of a breather today, but not a significant one. And a concerning thing here is that wave 3 is still green. It hasn't turned purple, which means the algorithm is saying it's not convinced that that wave 3 is done yet. Don't want to see oil prices go higher. As you know, if you've been watching, I've been surmising that perhaps oil stays in a big trading range. I know that when President-elect Trump gets in, the drill baby drill, we're going to have a lot more domestic production of oil. But my thought has been that with whatever increased production we get domestically, OPEC's just going to cut production to match it. OPEC does want to keep prices elevated, where obviously the Trump administration wants to bring energy prices down. It's a tough road to hoe. He's got a lot to do with everything that he wants to accomplish. It seems like every day you hear something different that is, quote, his focus, but that's, again, if you're believing what the media has to say. Why don't we just wait and see what actually happens once he becomes inaugurated? But the fact that that algorithm is keeping that at green means that we could go higher. I felt like we'd stay in this big trading range. I was surprised to see USO break above 80, but he hasn't taken office yet. So maybe that's why. And then maybe then we start to get a move down. The market usually looks 6 to 9 months ahead, so that surprises me a little bit, this break above 80 on USO, but a little bit of a breather today after a gap up and then a follow-through day. So a little bit of a breather here, so we have to be and have in the back of our minds that there is the potential of oil moving higher from here, at least on the USO. If we move over to natural gas, it's still cold here in the mountains. Snow's still on the ground from that storm. We talked about this on Thursday night with our insiders during our insiders meeting for alert subscribers at evotrader.com, and talked about whether or not we were going to see a bid come in with the snowstorm that was forecast. It happened, and we did. We had this previous gap where, again, vertical move, too far from the 10-day moving average. No security any time frame gets too far from the 10-day moving average, too far away from where we were underneath the support line and the 10-day moving average, as well as the gap. But consolidating, so we did have that bounce up on that weather, and we're kind of holding in there on UNG. So it looks like we just broke from this ascending triangle. We came down and tested it, came back to the 10-day moving average and satisfied that overbought condition on being too separated from it. And just as sideways consolidation with a slight tick up is pretty bullish. Probably the most bullish we've been on natural gas for quite some time. Those of you that like to trade natural gas, and I know a lot of you do, have been waiting for something to be significant and be behind on the bullish side of things. And we may have that now, breaking above that 17 level, coming back and testing it, and then holding and consolidating that move could be very bullish moving forward. So we take a look at Bitcoin, the cryptos. Wild volatility, as you know, had the huge move following the election, as we now have a crypto friendly, I tried to say, administration coming in. The big, huge run up in Bitcoin. We came down, we kind of held in there at the midpoint. This is really the trading range, these the upper and lower lines, but there's so much congestion here in the midpoint. I drew a line there as well because you can see how many times that we bounced off that. I know it trades 24/7, but it does give a date for end of day programs, software programs, as the calendar rolls over on Bitcoin. But we're back up a bit today on the chart. And we just had this one little blip down here to create the wave forward. Didn't quite make it to 38.2, but we did come down to the lower trend line that showed some support back in early November, right after the initial bounce after the election. We had the initial bounce, consolidated that, and then took off again, got above 100,000. And now every time we get to 100,000, we kind of bounce back down, but not significantly so. Pretty solid backing and filling there. If you're long Bitcoin, looking at Ethereum, also having a little bit of a bounce back today. We want to see Ethereum get back above 3,500 if you're long that, but holding above 3,000 is step number one. So if we can hold there, and look where that wave forward is, right at 61.8%. So a very strong fib level right here at the wave 4, and perhaps that holds and Ethereum can catch a bid and move to the upside. Once again, President-elect Trump talked about buying a bunch of Bitcoin to put to shore up the currency reserves for the U.S. government. And if he does do that, it seems like it'll keep a bid under Bitcoin, and perhaps stocks like Ethereum or securities like Ethereum, symbols, cryptos, whatever you want to call it, like Ethereum can catch another bid and take another run to the upside. We had Cardano that had a really nice run on the post-election crypto bump. You see we ran from 25 cents up to $1.25, just an amazing percentage return and pretty solid consolidation here, staying above the 50-day moving average. And then the one that a lot of people are talking about, and you could argue, I don't know about every single altcoin, but look at this chart where we had the big run up from 50 cents to 275, and we've gone through and consolidated that nicely, created a little bit of a descending triangle, but now it looks like we're breaking to the upside out of that. Remember, any triangle can break any direction. Don't want to keep going through that ascending triangles. Don't mean an upside breakout. Normal, just do descending triangles, make a downside breakout. Any triangle can break either direction, and looks like we're breaking out here on XRP. So pretty good place to be in the crypto world if you're in that space. So with that, let's take a look at some of our previous case study considerations here. We did EQR last week. We felt like it was going to go just a little bit lower, and it did initially. And then we came down and we actually hit the AI target. target, but we're looking for a continued move down towards this C wave extension. We'll see what happens with rates. The fact that it broke back above the 10-day moving average is interesting, with rates staying stubbornly high. But the inverted yield curve means not as stubbornly high as the short end of the curve is. But the question remains, is that a bounce off the AI target, or is it just an oversold bounce? And then we turn and head back lower down to the 100% extension. Remember, 61.8 is what it's supposed to do in a zigzag pattern that's right at the 38.2% V wave correction. You look for a 61.8% extension. We felt like it would continue on down to this 100% extension and go to 65. We'll see. So we'll be watching this, not just in where it closes today, but in tomorrow's trade, once again, to see if there's a follow through or confirmation day. Really important concepts there. The market gives a lot of head fakes. You have to be careful not to get caught in those. That's why the confirmation day or follow through day is so important. And then on CVS, that one, even though the healthcare sector has been struggling, caught a little bit of a bid off that 161.8% extension. There you go with a wave 4 that got above 70%, and yet the zigzag still worked perfectly. You can see that B wave went to 72%, and then we got 161.8% extension. So it does show that even though Elliot felt like if you get to 70%, you're probably going to disqualify, he didn't put it or didn't have enough belief in it, I guess you'd say, to make it part of the algorithm. The algorithm will still show a wave 4 if it occurs there. And so why not a B wave of a zigzag then, if it's wave 4 is going to hold that level. So down we're moving here in the C wave, got right to the 161.8% extension, and we've had a little bit of a bounce. But with everything going on there, I feel like maybe that's just an oversold bounce. It's a pretty well-formed 5-wave pattern to the downside. You can see the wave 4 has just gotten past 38.2. So this just may be a short-term bounce that rolls over and heads back to the downside. And then H on Hilton Hotels, or excuse me, Hyatt Hotels, we're hanging in here right at, look how this AI on this movement lower on the low end of the range. It's pretty amazing how it comes up with these targets. I don't know, over 300 data points. You got to be a computer scientist literally to understand what the algorithm is within the AI. But it's held right at the lower end, and we'll see if that continues to hold. And if it does, perhaps we get a little bit more of a bounce here, but that's going to be consumer tied obviously. And perhaps the CPI report tomorrow can put a bid under it, or it may break it down below the fail zone, and then we would have to take that one off as a loser. All right, Zach, so with that, I'm going to keep everybody in suspense on what we'll be looking at for a case study consideration for today. I'll take some questions, and then when we get to about 10 minutes left, I will come back and go through what we're going to look at for today's case study consideration, and then you can show the folks how they can post their own idea as we post our case study consideration for today. So any questions? Happy to take those now.
Absolutely. Sounds like a plan. We'll get right to it. First, though, I do want to share your movie quote selection has the chat calling us Dumb and Dumber, but Will was nice enough to specify that he wasn't referring to us.
Okay. All right.
Mention there.
Set myself up for that one, I suppose. Yep.
Yeah,
that is
all
the
titles.
movie.
That's the one you picked.
Yep, that is the movie, but
didn't think of it that way.
Maybe you should think before you speak, Rob.
All right, let's get into some questions. Couple symbols here from Manuel. First one's going to be BROS, BROS.
Dutch Brothers, and any stock in these kind of sectors has been pretty interesting lately. You can see the big gap up And if you're going to have, I don't like them when you get a vertical gap up, but if you're going to have one, this is the kind of consolidation that you want to have a possibility to go higher without much of a give back. In fact, we didn't give anything back from this big up day here. So the big gap up got a little too far from the 10-day moving average for my liking, but it's continued to move higher. That wave 3 is pretty strong. The issue for me, and if you're a person familiar with Elliot wave, you know that one of the complaints about the wave 3 is you don't know where it's going to end. And it's been my contention and the basis of the AI impulse strategy at evotrader.com that if you have a zigzag within the wave 3, you can come up with a pretty solid target on where the wave 3 is going to end. So you just look at where the fib levels are within the zigzag of the wave 3, and oftentimes the wave 3 will reverse off of one of those fib levels, whether it's the initial target price or an extended level. But there is no zigzag here in this wave 3. So let's take a look at the ADX and see what that is showing. And we're getting some divergence here as the stock continues to move higher. So we'll just spin this arrow around. As the stock continues to move up, the ADX has been moving down, which means that we are continuing to go to the upside. But as we continue to go to the upside, the move is getting weaker and weaker. Remember, in the DMI, the ADX measures the strength of the move, not the trend, the strength of the move. The two directional indicators tell you who's in control, buyers or sellers. Positive directional indicator, represented in green, is the buyers, and the negative directional indicator, indicated in red, is the sellers. So buying pressure and selling pressure. So I'll be a little bit concerned about this wave 3 with the fact that as we continue to move higher in price, we're continuing to move lower in strength. Maybe we're starting to see a little, turn back to the upside on the ADX, but I'd be cautious of this. If you're long, I would tighten the stops in case we start to get a reversal, since again we haven't really given anything back from that big upward move. Was that right around election day? With this ADX telling you that strength is waning, you could start to see a wave 4 correction start at any point in time. Just out of curiosity, I want to look at the CCI. That's a little shorter term, and it came down, got a little bit above. So this new software platform from HUBB will actually shade the amount above either positive 100 or negative 100. So if you're familiar with the CCI, that's kind of the range. You get to 100, and then you're starting to get a little bit overbought. You get to negative 100, you're getting a little bit oversold. And then when you have these big moves, you can create what are known as extreme points. So this big move up here, that would be an extreme point. So the software actually shades this area either above positive 100 or below negative 100 so that you can start looking for those extreme points. So it tells you that, oh, wow, that was a really strong move. And we did continue higher, but at nowhere near the velocity of that initial move. And then another thing that I think is concerning is as we made a new high in price, we didn't come close to making a new high on the CCI. So once again, divergence. So we have the divergence in the ADX. We have divergence in the CCI. It is ticking to the upside above positive 100. That's the most positive thing I can say, other than the fact that the chart really consolidated its breakout move very well. But again, I think caution here. And if you're long, tighten up your stops. The wave 3 is still green, so the algorithm's not sure that it's over. But I think the prudent thing to do is put tighter stops, and then if it continues to run, you take advantage of them. But if you start to get a correction, you protect the profits that you've made already. And you can see that line there that acted as resistance back in early December. Then we traded right underneath it, broke above it, tested it, and now it looks like we're trying to break from it, is at 55. So I think a viable stop on this stock would be at 55. And you can let it run if you'd like to, or hope to run at anything above 55.
Thanks for the detailed analysis there, Rob. Next symbol from Manuel is going to be SBUX, SBUX.
Good old Starbucks. Still, a company I don't understand why people pay so much money for a cup of coffee. It just blows me away. But a lot of people do, because every time you find one, there's a line. But you came down here to the wave 4. We had this pretty vertical sell-off here, got a little too far to the downside, too fast, too far from the 10-day moving average. We came back up, and we've been trading right around the 10-day moving average ever since. We're trying to break back above the 30 and 50-day moving averages. We are above the 10-day, but we need to get back above the 50-day. And if we do, if we can close above that 50-day moving average with follow through, you have to start looking at the possibility that we're in a wave 5 to the upside. Maybe tame consumer data out of the CPI tomorrow could put a bid back into these stocks. That the jobs report pretty hurting on anything in the food space, and you can argue whether coffee's in the food space or not, but anything along these lines, restaurants, etc., had a little bit of a rough go, but maybe we turn and move back to the upside. But for me to go long Starbucks, if you're long right now, I don't see any reason to get out. You've already had this big move lower. But if you're looking for an entry to get in to go long, I think you want to wait until we close back above the 50-day moving average. And then we're looking at 100 again at that point in time, and we can reevaluate and see if we can break above a 100. You can see we have this little quite tight corridor here, right in this area here between 100 and call it 102. It's a pretty small corridor right through there. So if we break above the 50-day moving average, we're most likely going to come back and test 100, but we have to do it first and see, make sure we don't roll over. But a pretty solid wave 4 there at 55% could act as an outlier to get the market moving back to the upside, or Starbucks moving back to the upside. But it's the Missouri analogy now. It's got to show us by closing back above the 50-day moving average. Then I think you got a pretty good trade to 100 at that point.
Very well. Next up, we have Colby. Wants to know what's going on with Palantir, PLTR.
Yeah. You and a lot of people want to know what's going on with this company. But it's moved exchanges. So the data, when you're looking at the charts, can be a bit odd. They'll get all that cleaned up. The exchanges, it's the exchanges needing to talk to each other and do a little backing and filling with their data feeds. They don't really like each other, the exchanges, too much. So sometimes it takes a little while for them to get their act together. It wasn't this big of a gap down, but we are trading down here. But back above the 50-day moving average. The issue is the wave 4 is still colored green, so it's not sure the algorithm that the wave 4 is done. But we are trying to get back above that 50-day moving average, and if we can do that, the next step would be above the 10-day. So if you're long Palantir, I would hold it. If you're looking to get in Palantir, I'd wait for it to break above 70. I'd want to see it back above that 10-day moving average. You could get in before you get a curve back to the upside on the 10-day moving average. It has not given a bearish cross, but you want to see at least back above the 10-day moving average. So also, if you're bearish, you're like, oh, just come up and fill this gap. But remember, it's not really a gap like that. So it's more about the 10-day moving average here. And if we can hold into the close today above the 50-day moving average, you can see it's literally sitting right on it at this moment.
Thanks, Rob. You covered the crypto space. I'm still loving that move on XRP. This one's going to be on MSTR, MicroStrategy.
Yeah, basically Bitcoin, MicroStrategy is now. And Saylor has pretty much leveraged the entire company on Bitcoin. Huge believer in it. I've made some comments that the board must love him because a very unorthodox, I think one could say, management strategy to do something like this, but it's been working so far. And as long as crypto goes higher, MicroStrategy is going to go higher. So pretty much MicroStrategy moves now in lockstep with Bitcoin because they have so much leverage. But he's done a really smart job on the way he's done his debt offerings, etc., in raising money to buy more Bitcoin, almost borrowing the money for free, not quite. You can never do it completely for free, but if you go back and look at some of the financing moves he's made, it's been pretty creative to acquire more Bitcoin. And if we start to see another run in Bitcoin back above 100,000 or so, you're going to see MicroStrategy take off. So if you're looking for a way to play Bitcoin and like, I don't want to go out there and pay $100,000 for one coin, and I'm not really excited about buying partial coins because you only get partial move. A leveraged way that you could play in the Bitcoin space would be to buy options on MicroStrategy. So that's where you could gain some leverage. And the chart looks pretty good, but it's going to be pretty much in lockstep with Bitcoin. But MicroStrategy is a way through options on the stock that you could trade in the Bitcoin space for a lot less money than actually buying a Bitcoin.
Thanks, Rob.
I would point out here before sorry, Zach, interrupted you. I paused, but then just wanted to make one final note here with that wave 4 right at the 61.8% level. It's a pretty solid level to try to support and hold and see if we can move back to the upside here. So if it's going to, it's at a good level and it's trying to get back above all the major moving averages. It's trading there right now. Can it hold that into the close?
Alrighty, let's head over to Rocket Lab for Lisa, RKLB.
Oops. Haven't looked at this one in a little while. It's got a little bit of a weak wave 4. The positive side of that is, again, if you're looking at the writings from Elliot, he wasn't a big fan of the 23.6% fib level acting as a corrective move. He thought that was more just the gyrations of the market. The crux of Elliott wave is the market moves in impulses and corrections. It's just, do we get the corrections down to fib levels? They can act as support, etc. But his viewpoint is if you only came down to the 23.6% level, you might actually just be continuing the current wave. Note that the wave 4 is still green, so it's not labeled that as a confirmed wave 4. And so if we did bounce back to the upside on Rocket Lab and made a new high, now you could see this 3 move over. That's the gist of what I'm talking about here, with the fact that he didn't really feel that 23.6 was a full-on correction. So in his idea, that wouldn't be a wave 4. That's just a pullback. And then if we move and make a new high and the 3 moves over, that would confirm that, and this would go away. But if we break down further, we could solidify the wave 4. But for right now, if you're long this stock, I wouldn't get out, although it's a little nervous that you're below the 10-day moving average. But as long as you can stay above the 50, I think you're okay. So if you're long, that would be what I'd watch, is the 50-day moving average. See if we turn and get a bounce back to the upside, ideally back above the 10-day moving average. But for now, if I was long, even though the past few days probably haven't felt too good, I don't see any reason to get out. Let's see how it handles the 50-day moving average first, and then we can make a determination from there.
Thanks, Rob. Next up, we have Wigmar, NVO, Novo Nordisk. Will wave 4 be possible to close gap at 100-ish and wave 5 end at 60-ish, or can it relabel so bottom soon as in?
Relabeling is possible at any point in time, which is why a lot of people say negative things about Elliott wave on the relabeling. And I think they've got it 180 degrees the wrong way. I think that's one of the greatest things about Elliott wave, the market, and we may be in one of those. You said it when we started, Zach, in a state of flux, where we may be oscillating between this big, long bullish market that we've had and moving into corrective mode. Don't know that for sure yet because we didn't get the follow through yesterday, but we still have to respect that possibility and respect that the bond market is telling us that something's wrong. Maybe it's a black swan event. Maybe it's not the U.S. economy, but something is wrong somewhere. And you take a look at NVO going sideways here. We're breaking down today. The wave 3 is still green. So the algorithm is not sure the wave 3 is done yet, even with today's move. Maybe after tonight's update, depending on where it closes, that could get turned green. Purple, and then we move back to the upside. And by the way, you can change those colorings. There's different coloring choices. I just use the green as the indicator of a current wave and purple as the indicator of a completed or confirmed wave. You see this, and it could find this bottom at any point in time. But the breakdown today is probably frustrating for anyone that's long the stock. It was going sideways so nicely here that you would have liked to have seen a bounce higher off of that. The old launch pad effect, Zach, that we used to talk about a lot, where a stock consolidates sideways and then takes off, like blast off. So the sideways part is like the launch pad, and then you get the blast off move. But in this case, it moved lower. And we have mentioned that the launch pad effect can work either direction. It just seems normally it's an upward break. But in this case, it broke lower. So breaking down out of this consolidation is certainly concerning if you're long the stock and not really a zigzag here. You could argue that, well, there's a crude one if you start to look at where this impulse move started right back here in October. And then we had the move into November, right at a just above 61.8% corrective move there. And then you can see right now we're at the 100% extension. So right at the 100% extension with today's move, maybe that's it. Maybe that is the end of the wave 3, and we turn and bounce from here. A little bit oversold also based on today's move. And then if you look at the DMI, as you know, I'm not as big a fan of the DMI on downward moves, and that's because it can be a little bit of a lagging indicator, the ADX especially. The two directional indicators are far more responsive to day-to-day movement, but the ADX can be a little bit lagging. And so I tend not to look at that as much on a downward move as I do on an upward move. One of my favorite indicators on an upward move to confirm what Elliot wave is showing and the AI. But I do like to look at the CCI on downward moves because it's far more responsive to day-to-day movements. And you can see that we had an extreme point low. We came back up, didn't quite make it back to zero. The movement to the upside was encouraging, but the break back down below zero is not, and dangerously close to breaking below negative 100, which could mean a lower wave 3 low. But for now, we'll see if that 161.8% extension move can hold, and maybe we get a little bit of a bounce here. But that's danger, Will Robinson on that one right now.
Thanks, Rob. I see we're at 10 minutes till the hour, so perhaps I'll give you this last symbol, and then we can pass back over to you for the case study consideration.
All right. Sounds good.
Let's go ahead and go with Nike NKE for trade simple.
Oh, good. We haven't looked at Nike in a while. Says good one to take a look at here. And as you can see with where we are on the chart, that we've broken to the downside here and getting to a point where we're not too far away from its target. Note that the AI gave this a 64% chance. Even the readings in the 60s seem to work really well on the downside moves, even though as much as I try in chatting with the data scientists at the HUBB organization to say, hey, isn't it alert worthy at readings below 75? The downward moves seem to work just as well with lower scores as the upward ones do with higher scores. And they still stand pat with that score of 75. I bend it down to 70, but 64 is a little bit low, even though appears to be working just fine, even with a little bit lower score. So 64 Looks like we want to come down here to 69.17, but that's not too far away. Really, basically, we're almost at 71, so it's just a little over $1. Move lower from here could be an area that it finds support. Once again, the wave 3 is in green, so the algorithm is not convinced it's over with, but the AI is telling you we could be nearing a point where you would expect the downward move to end. So maybe we turn back to the upside. But just remember, when we've had these stocks that have broken down, there's been a lot of them as the market has seemingly starting to move from a bull market to corrective move. All that could change tomorrow with the CPI report, but it certainly feels that that's what the market's doing. And the first thing that you want to know when the selling is over is to close back above the 10-day moving average. So that's the first thing that we would need to see happen, is for the stock to get back above the 10-day moving average. So we'll see how that plays out. But our case study consideration for this is that we're going to go back to one of our old friends and one that we've been looking for a while, UNG. And the reason for that is what I highlighted earlier. The gap up, vertical move, came back down, tested the upper trend line of the ascending triangle, tested the 50-day moving average, broke up, and held there. So your stop would be right in this area. Let's just call it 17 would be the stop there, just below where the 10-day moving average is right now. But natural gas looks like it has a bid under it. I know that would be kind of counterintuitive with the incoming administration's desire to bring energy prices down. But you can't ignore the chart. And there really isn't a qualified AI signal that we'd want to put out today. So we'll look at natural gas, old school style, with its break above and then back down to test that upper trend line of the ascending triangle and then breaking higher. And so the question would become, okay, well, where can we go from here? So if I widen out the chart just a little bit and take this arrow off, and then we get the moving averages off so we can see it just a little bit better, you can probably note, I hope you can, the formation of a potential zigzag. So we always want to use the tool to measure it. There would be your impulse A and the B correcting right just below 61.8. And that would give us a price on natural gas up in the 21.5 range, I would say. So just below 22. So right around 21.5 is what we'd be looking at for natural gas. So that's the one we're going to post for the case study idea today, Zach.
Very well. All right, so we'll head over to the platform now. And is this going to be an official idea or a post?
We'll do this one as a post since it doesn't follow all the rules.
Okay, very well. So I'll make sure to differentiate between the two here. Everyone can see the platform now. And as I click on this light bulb up located on the right toolbar furthest on the left side, we can come over here to the new ideas toggle. We have the option to create an idea or a post. Typically, or most often, we'll create an idea, but today we're going to go with a post. As Rob mentioned, the criteria is not completely fulfilled, so we're going to be waiting to see a few more things play out before making that an official idea. We'll come back and make this a bit prettier after this session is over, and we encourage you to interact by commenting your thoughts, whether you agree or disagree. As Rob said many times in the past, and I echo, differing opinions is what makes markets, or rather opposing opinions is what makes markets. There'd be no transaction, no trade to occur if everyone agreed and thought the same thing was going to happen for each stock or symbol. And so we'll go ahead and post this now. And again, I will be adding a lot to that here shortly, right after the session. We encourage you to add your thoughts as well on the discussion board. I'll show you where that can be accessed here. If we go to my feed, you can come over here, and as we can see, that was just posted, and you have the option to give it a thumbs up, thumbs down, reply to it again with your thoughts, as I mentioned, and you can also scroll down and see some of the other posts from our growing community here. We have our session from Monday with the HUBB Live Trading Room available through the training on using HUBB AI signals, which I'll show you where that can be accessed as well here in the HUBB AI signals group. We have any of our beta testers feedback forum here as well, and the EWO subscribers group, which will be coming soon. So looking forward to getting that one posted so we can interact as our EWO group in that message, or in that forum rather. And so with that, Rob, I'll pass back over to you with closing thoughts and let everyone get back to the markets. And just want to thank you all again for taking the time to attend.
Yeah, love doing these sessions. Boy, we had some really fun things to look at intraday yesterday. So like the fact that we do these intraday. Let's take one quick look at where the intraday chart is on the S&P. We are still firmly testing that support level. And again, I think that's exactly what's going on. We didn't get a follow-through break to the downside. So now we're testing that level of support that was broken to see if it holds. Here's what's happened intraday. I like the 3-minute chart. We sold off, even though we had that better than expected PPI. And then we've turned and rallied back to the upside. And once we get back, we're getting awfully close to that exact level where my trend line is. If we can get back above that, then we can disqualify that breakdown that occurred. And then it's a no harm, no foul event. But until we can close back above this trend line right here, just call it right at 584 or so, we have to take that as a breakdown just without a follow through yet. Note that the S&P has moved up quite a bit. And once again, going back to the 3-minute chart from when we started an hour ago, you can see that 12:30, and then we started at 1. We're in this area, and we've basically just been ticking up ever since then. And that will be the key where we close today as far as its relationship to that support line. And all eyes will be on the CPI tomorrow. As I said, this report, although encouraging on the inflationary front, doesn't carry as much weight in the markets as the CPI report does. So all this could change tomorrow, and we'll wait and see. One quick look at the 10-day moving average, and that would be the next step. If we can close back above that support line, you'd want to see back above the 10-day moving average. So thanks for spending some of your trading day with us. We appreciate it very much. We value your time. We know it's valuable, and we appreciate you devoting some of it to us, and we do our best to make it an informative and educational use of your time. Let's see where we close today. Look forward to talking again soon. Take care, everybody.